expert advice. These days we have been hearing a lot about the interest rate cut. Many people say interest rate cuts will bring down property prices. Now what exactly this rate cut will do and what kind of effect will it have on the property market? We'll discuss this with our guest, Mr. Paresh Karia, who's the director of Easy2ownEstate, as well as he's a real estate expert for years now. Now first, let's welcome him on our show. Welcome to the show, sir.
Yeah, thanks, Pooja.
Okay, so since I mentioned about the RBI rate cut, which has been, a talked about topic these days, and people say, the property market will have correction, property prices will go down. Now, I would like to know what is the exact relation between the interest rate cut and the property market?
See, Pooja, as you would know that, purchasing a property is one of the biggest financial decision and involves huge amount. And nowadays that we are seeing that more and more people are buying property by availing of loan. Typically, when you buy a property, you put about 20 to 30% out of your own pocket, and rest of the money, about 70 to 80%, you take on a loan. So whenever you are taking any loan, you have to pay interest on it. So your cost will increase by the cost of the interest. And your cash outflow will accordingly increase. Now, if the interest rate is high, obviously you have to pay more interest and your outflow will be more, and so will be the cost of the property. And conversely, if the interest rate is low, your cash outflow will be less, and so will be the cost of the property. So that is how, when we see that when interest rates are high, there is less demand for property. When interest rates are low, there is more demand for property.
So you mentioned about fixed rate and floating rate. Now first tell me, what is actually fixed rate?
See, fixed rate, like the name denotes, there's a rate whereby the rate of interest will remain fixed for the entire tenure of the loan. Suppose you are going for a loan for a period of, let's say, 15 years, and the rate at which you have contracted the loan is, let's say, 11%. Then throughout the period of 15 years, you will have to pay interest at a rate of 11% only, irrespective of whatever happens, whether interest rates go up or down in the market. So this also means that your EMI will remain the fixed.
Now let me ask you, what is floating rate?
Floating rate is a rate, where the interest rate will keep on changing depending upon the prevailing interest rates in the economy. This is a concept which has become popular over the last 10 years, because earlier we had seen there were only fixed rate loans. Now, interest rate is playing a very important role in the economy. Interest rate keeps on moving up and down. So accordingly, the housing loan rate also keeps on moving up and down.
Okay, sir. Now I would like to know, what is floating rate?
Floating rate interest is a rate at which will keep on changing depending upon the general prevailing interest rates. If the rates in the economy go up, then the floating rate will go up. If the rates come down, the floating rate is also supposed to come down. Now, nowadays, if we see that most of the retail loans are floating rate. Now, the way the floating rate concept works is every bank has its own base rate, which is the rate to which all the loans are linked. So there are two components we need to keep in mind. One is the base rate, and the second is the margin.
Okay, I would like to ask you, what is actually base rate?
Base rate, as I said, is the benchmark rate which all banks have, and all their loans, are linked to this particular base rate. And if the base rate changes, then all the other interest rates will also change.
And you were speaking about another marginal rate.
Yeah. So typically what happens is that there is a base rate and there is a margin. So the interest rate which is charged to a borrower is a function of base rate and margin. Suppose the base rate of the bank is 10%. And if the housing loan, if I've entered into a contract with the bank for taking a loan at base rate plus 50 basis points. This means that I will have to pay interest at a rate of 10.5%.
Okay.
Now, if suppose the general interest rates in the economy go up and the bank decides to increase its base rate, then the base rate will become 10%. Let's say increases the base rate by half a percentage point or 50 basis points. Then the base rate will be 10.5%. And my margin is another 0.5%, so my interest rate will be 11% instead of 10.5% earlier. Similarly, if let's say the interest rate in the economy comes down by half a percentage point, the bank may choose to reduce its base rate by half a percentage point, in which case the base rate will become 9.5%, and my loan, which is at 50 basis points more than the base rate, will become 10%.
Okay, here I would like to ask you, what is basis point?
So basis point is nothing but just a technical term. It is used to denote a fraction of a percentage point. Whether you say 0.5% or 50 basis points, it's one and the same. The reason why this term is used basis points because 0.25% or 0.5%, it sounds too small.
Correct.
So for the convenience of speaking, they were using basis points.
So talking about the interest rates, what should one go for? Either fixed or floating?
Yeah, well, it depends upon one's view, outlook on the interest rate and one's kind of a risk-taking appetite. Now, if you want to be conservative, if you want to keep your cash outflow constant, you don't want to face any uncertainty with regard to ups and downs in the interest rate, then you can go for a fixed rate loan.
Okay.
But having said that, we need to keep it in mind that fixed rate loans are always costly. You have to pay slightly more than the prevailing floating rate. Currently, if suppose the floating rate interest rate is about 10%, then the fixed rate will be 11 or 12%.
Okay.
Also, fixed rate is typically suitable when the interest rate cycles have bottomed out. When you feel that the interest rates are not likely to go any further, and in future it may go up, then probably at that point of time you can take an opportunity of lower interest rate and lock into the rate by going in for a fixed rate loan.
Okay.
Whereas floating rate, on the other hand, if you feel that interest rates are going to come down, and in that case, you should go for a floating rate loan.
Now, my next question is, what are the different factors, that determine the interest rate?
Well, that's, there are several factors, economic and otherwise, which determine the interest rate in an economy. Let us talk about the two most important factors. The first and the foremost factor which determines the interest rate is the rate of inflation prevailing in the economy.
Okay.
Right? As we all know that inflation is nothing but increase in the prices. And interest that you earn is nothing but the compensation for postponing your consumption. Suppose you are having let's say 100 rupees today. You put it aside. You have two options. Either you use that 100 rupees to spend it immediately, or you will keep it aside, put it in a bank with interest at let's say 10%, and use it for consumption after 1 year. Now suppose after 1 year, your 100 rupees becomes 110. But if the rate of inflation is more than 10%, let's say it's 12%, then the cost of consumption at that point of time is 112, whereas what you will have is 110. So you will actually be into a loss.
Okay.
So it is very important that interest rates, inflation remains low than the interest rate.
We are taking a really short break. Stay with us. What are the different factors that determine the interest rate?
Well, as you see, there are many factors which determine the interest rate in an economy. Let us discuss the two most important. The first and the foremost factor is inflation.
Welcome back to Expert Advice. We were speaking with Mr. Paresh Karia on the innovative financing schemes that builders and developers are offering today. So let's take this conversation further. Now I would like to know what are the different factors that determine the interest rate?
Well, as you see, there are many factors which determine the interest rate in an economy. Let us discuss the two most important. The first and the foremost factor is inflation. As we know, inflation is nothing but a rate of increase in the prices. And if the prices are high, the interest rate tends to be high. If the inflation rate is low, interest rate tends to be low. The second important factor which determines the interest rate is nothing but the demand and supply for money in the system. Just like any other product, the prices of the interest rates are also determined by what is the demand of money and what is the supply for the money. So if there is more demand and there is less supply, the interest rates will be high. Conversely, if there is more supply and less demand, then the interest rates will be low.
So as we all know, RBI also has a pivotal role in interest rate cuts, as they are the ones who announce the rate cuts. So what role actually RBI plays in determining the interest rate? That I would like to.
Well, RBI plays a very important role in managing the interest rate in the system. There are two ways in which RBI manages interest rate in the system, direct and indirect. By direct way, the RBI will manage the interest rate by increasing or decreasing the rates. Now, to understand this, let us go into the basics of the economy and banking. As we all know that RBI is the lender of the last resort. So anybody who wants to banks, people borrow money from the bank, and banks ultimately, if they need money, they borrow it from the RBI. So RBI is the one which will set the interest rates in the economy. We have something known as the bank rate. Bank rate is the rate at which commercial banks borrow from RBI. So this rate, RBI can change interest rate over a period for the long term by changing the base rate, or interest rate. The second way in which RBI can change the interest rate is by changing the repo rate. Now let us understand what is a repo. Repo is nothing but an option by the banks, commercial banks, to borrow money for short term from the Reserve Bank by lending the securities. As we know, most of the banks are required to hold government securities. So whenever they are in need of short-term funds, they can place the securities with the banks, and against this they can borrow money for the short term.
Okay.
And the rate at which they borrow from the RBI is known as the repo rate.
Okay.
So by influencing the base rate, this interest rate and the repo rate, RBI can change the rates into the system.
Okay.
RBI changes the interest rate, the bank rate, for if it wants to bring about a long-term change in the rate, and whereas repo rate cuts are used for bringing about changes in the short term.
Okay, so there is a general perception amongst people that when the RBI rate cut happens, they think that EMI of their housing loans will also go down. So what is your stance on this?
Well, that's a very good question, Pooja. Whenever we see RBI reducing a repo rate or some other rate, we see newspapers screaming that your EMI rates are going to come down. Well, let me tell you that does not necessarily happen. See, whenever RBI reduces the rate, it is not mandatory for all the banks to reduce the rate. When RBI, for instance, reduces the repo rate, it is only at the rate at which the banks borrow from the bank that is reduced. So banks may take a call depending upon the market conditions, depending upon their own profitability, depending upon their own cost of funds, whether to reduce the rate or not. If after RBI has announced a rate, the bank decides to pass on this benefit to the consumer and borrower, then what it will do is it will reduce its base rate. If it reduces the base rate, like we explained earlier, if base rate becomes from 10% to, let's say, 9.5%, and if my loan is at 0.5% above the base rate, then my interest rate on my loan will also come down by 0.5 percentage point. But if the bank doesn't reduce the base rate, then my interest rate will not come down, my EMI will not come down.
Okay.
We have also seen that many times, the banks, in order to attract new customers, what they do is they offer low rate to the new customers, and they don't reduce the rate for the existing customers. This they achieve by keeping the base rate constant and by changing the margin.
Okay.
Now if they keep the base rate constant at 10% and reduce the margin on the loan from, let's say, for 0.5% to 0.25%, so the new borrowers will get a loan at 10.25%, whereas existing borrowers will continue to pay rate at a rate of 10.5%.
So that's quite a startling revelation, I think.
Well, yes, this has been a common knowledge, but unfortunately, too many customers, bank borrowers are not aware about that.
Correct.
They generally assume, they don't bother to go and check with the banks what exactly is happening with their loan portfolio. They generally assume that if the interest rates have come down, therefore, loans interest rate has also come down.
Okay, sir. Now I would like to know what are the factors that a home loan borrower needs to keep in mind when the rates are down?
See, it is very important for a borrower to know what is the rate of interest that he is paying. Like we discussed earlier, the floating rate is a function of a base rate and the margin. So the first thing that any borrower should do is revisit his loan document or talk to his lender and find out what is the benchmark, to what benchmark is this loan linked, and what is the spread. What is the base rate and what is the spread. So after that, he needs to check that whether the bank has reduced the base rate. If so, then his loan rate will automatically come down. And if the bank has not reduced the base rate, he needs to see whether there is, bank is offering a lower spread, rate at a lower spread to the new borrowers. If the bank is offering the loan at a lower spread to the new borrowers, he can always approach the bank and try to renegotiate the spread. For instance, if his spread is 50 basis points above the base rate and the bank is giving at a rate of 0.25% to the new borrowers, the existing borrower can approach the bank and try to negotiate and tell them, give me also at a rate of 0.25% above the base rate. And generally, most of the banks do permit their borrowers to switch over from a higher spread to a lower spread by paying some fee.
Okay.
Now, the other thing he can do is that if he finds that there is some other bank, he needs to see what are the other banks offering in the market, what is their base rate and what is spread. And if he finds that other banks are offering a lower rate, he can always switch over, close his loan from the existing bank and move over to a new bank. And nowadays, as we know that, there is no foreclosure penalty. Most of the banks will not charge you any penalty when you close their loan and move elsewhere. Okay. So it is very important for the buyer to constantly keep on observing what is the base rate that his bank is following, what is the spread, and what are the rates which other banks are offering, and what are the options available. And depending upon that, either he can renegotiate with his bank or move over to the new bank.
Okay. So we have also heard about home loan transfer. Could you explain on that topic to our viewers?
See, a home loan transfer is nothing but, like we discussed, if there is some other bank which is offering you favorable terms than your bank, you can always transfer your outstanding balance to the new bank. And nowadays, like we know that there is no penalty for such transfer. So, earlier there used to be some penalty because of which the home loan borrowers were reluctant to move. Now there being no penalty, the market has become very competitive, and all the lenders, home loan providers are on their toes. They try to maintain the rate very competitive so that they don't lose the customers.
We are taking a really short break. Stay with us. So if I asked you to summarize the entire conversation, how would you?
They should be aware of what is the benchmark rate at which their home loan is linked to, what is the base rate of the bank, and what is the spread.
Welcome back to Expert Advice. We were speaking with Mr. Paresh Karia on the innovative financing schemes that builders and developers are offering today. So let's take this conversation further. Talking about home loan transfer. If I wish to have a home loan transfer, what are the kind of benefits that I can reap by this procedure?
Yeah, if you transfer your loan, obviously, you can get better terms. Better terms could be A's in terms of the interest rate. You will have to pay, the new bank may be providing you a lower interest rate, in which case your EMI will come down. Or secondly, you may have a more eligibility. The new bank will be providing you more loan than the existing one, in which case your amount that you can borrow will go up. So you can avail of more loans, so these benefits are available. And one needs to keep in mind, that when you are transferring the loan, you have to go through the entire process of documentation. And this is again one of the deterrent, one of the reasons why people do not want to go through the hassles of doing the documentation with a new bank, getting the existing documents, property documents which are pledged with the existing bank, getting them released, and then transferring them to the new bank.
Okay.
Right? So that is the reason why most of the people are reluctant to move their home loan. But if you see the kind of benefit that you get, if you transfer it, your EMI can come down, then the benefit far out now surpasses the inconvenience which is there involved in shifting the documents. Home loan borrowers should take the pain of going through the document if it is going to result in savings in EMI.
Okay. We've also heard about smart loans, super saver, packages available in the market. Could you tell us more about these offers?
Yeah, this is some very interesting and innovative, banking home loan products which are available in the market. Now, many of the Indian banks as well as foreign banks are offering this kind of products. This is nothing but, simply a home loan which is linked to your overdraft account. Now, typically what happens is when you take a loan, right, you want the entire outstanding amount, you have to pay interest. And the interest could be on a reducing balance. The reducing balance could be monthly or annual reducing balance. And but the entire amount on that, whatever is outstanding, on that you have to pay interest. Now it may so happen that sometimes, you may have surplus funds in your account. You may get a bonus, or if you have sold some, property for which you will get the money. Now that money you will typically go and keep in your savings account. On your savings account, or usually you will get about 4% interest. So on one hand, whatever surplus money you have with you is parked in the bank at 4% interest, and you are still taking a home loan at a rate on which you are paying interest of 10% and above. So in case of smart loans, the way it works is that you have a kind of an OD account. So whenever you have a surplus, your loan amount for outstanding amount functions like an overdraft account. So whenever you have, let's say, surplus, your loan amount is, let's say, 50 lakhs. And now you have a surplus, you have a 5 lakhs money flow coming into your account. Instead of putting it in savings account, you deposit on your home loan account. So your balance, your outstanding balance will come down from 50 lakhs to 45 lakhs. So you will be paying interest only on 45 lakhs.
Okay.
So indirectly, if you have put that money, if you would have put that money in the bank deposit, so if it was lying in your savings account, you would earn only 4%. Whereas over here, you are saving 10%. So effectively, you are getting 6% more.
Okay.
So this is a very innovative concept, and I would urge all the home borrowers to take a look at it, especially those who are into, who keep on getting regular cash flows. Then this is one way in which you can reduce your interest outflow.
I hope the viewers heard this properly. Now, there's something known as part payment also. Now, could you tell our viewers what exactly is part payment?
Well, part payment, like we discussed earlier, in case of smart loans, we said that whenever you have a surplus, you can go and deposit your money into that account. Now, let me first explain to you another benefit of that account. That account can be used like your normal savings account. You can, whenever you have a surplus money, you can park it, and whenever you need the money, you can withdraw out of it. So suppose if your balance is 50 lakhs and you have deposited 5 lakhs over there, so your outstanding balance becomes 45 lakhs. Now your limit, bank loan limit is 50 lakhs. You have 5 lakhs, 5 lakhs of positive balance lying in that account. So you can withdraw anytime up to the extent of that 5 lakhs.
Okay.
So that money can be used up to the extent of your loan limit. It can be used like your normal savings account, and you can withdraw the money, deposit the money whenever you want. Now coming back to the part payment, what happens in case of a part payment is that whenever you have any surplus funds and you want to reduce your loan, outstanding loan amount, you can go and pay it to the bank. You can repay the loan and your outstanding loan amount will reduce to that extent. After that, you can decide on two things. Either you can rework your EMI, suppose you have a loan of 10 lakhs, you have a loan of 50 lakhs, and you want to make a part payment of 10 lakhs. So either you can make your loan amount of 40 lakhs and ask the bank to reduce the EMI, keeping the tenure of the loan same. Or the second thing you can do is you can keep the EMI the same and ask the bank to reduce the tenure of the loan.
So if I ask you to summarize the entire conversation, how would you do it?
Well, I would say that, home borrowers should keep a few things in mind whenever they are available for home loan. First thing should be aware of this. They should be aware of what is the benchmark rate at which their home loan is linked to, what is the base rate of the bank, and what is the spread. And they should constantly monitor this. They should keep visiting the banks, just like we go and check and update our bank savings bank account regularly. One should also keep on updating their loan account regularly to see what is the rate and what are the factors which the banks have charging. Whether banks have reduced the benchmark, the base rate, whether the banks have reduced the spread, or whether there is any other scheme being offered by the bank to switch over from a higher rate to a lower rate.
Okay.
Second thing, they should also always keep in mind and keep on looking out for other options available in the market. Constantly watch what the competition is offering, what the other competitive bank is offering. If the other bank is offering you better terms than your existing bank, then you should evaluate the option of renegotiating with your existing bank or switching over.
Okay.
And third and the most important thing that they need to keep in mind is to see whether they really need to continue with the loan or they can pay it off and square it off. Many times we have seen that people, keep money lying idle in their savings account, or in some other investment which will not yield result and continue to pay interest on their housing loan. So if at all they have surplus funds somewhere else which they are not able to deploy it profitability, it is better to repay it, your bank loan, and save your interest outflow.
Okay, so thank you so much for such a useful information, sir.
Thank you.
And thanks a lot for coming on our show.
Thank you very much.
This was Mr. Paresh Karia speaking on the interest rate cut and the points that a home loan borrower should keep in mind when the rates are down. For more such information on rate cuts and real estate as a whole, keep watching Spin TV. Goodbye, take care.